Hello and good morning, folks. It's Friday, end of the week with limited action but still volatile time for currencies. This is Almus Market Mornings with Shikhar Garg, and I just happened to browse through some interesting data. Well, we have heard of the economic bubble being burst a few times in these cycles, but after all the last three bubble bursts, the fundamentals spoke a different story altogether, only to post the largest part of their decline in the equity markets right after the rate cuts. So that's quite an interesting analogy. Whereas in the current markets, we are all seeing some bit of momentum or rallies in the anticipation of the rate cuts. And on the other hand, the US just posted its GDP numbers, which does show the year ending with some good growth momentum. So, JK, what's your thought? I mean, do we see any juice in growth going forward, or it's the radical move that we should be anticipating right after the rate cuts?
Yeah, good morning. Definitely, the US numbers were on the focus yesterday after GDP came much higher than expected. And, that was mainly led by consumption. And market opinion is divided as to what it could be going forward because eventually the higher interest rates are expected to impact the consumption through higher interest costs, as well as GDP has been held up due to large inventories, and that may fade. The effect of that may fade in the coming months as well. So the headline number is good, but I think one cannot be too optimistic how it goes going forward. Jobless claims, of course, is impressive at 1,86,000, and expectation was at 2,05,000. And last week it was at 1,90,000. This is the lowest number after April 2022. But this is happening even as more and more companies are cutting costs, and that can that cannot cutting costs and jobs, and that cannot be ignored. Durable goods orders also jumped by 5.6% in December because of flush of new contracts for Boeing planes. So our business investment was weak, and that was another sign of corroding US economy. So it's like we have strong headline numbers, but the details are not too promising. Definitely, investors would like to take sober view and wait for more confirmation or more clues on the economy. But definitely, there is some sense of uh, possibly US Fed, sounding mildly hawkish and not changing their stance as far as the Fed meeting in the coming week is concerned. But on a more positive note was German situation, where the IFO survey once again came strong. It came at 90.2 in line with consensus, but definitely much above the previous month's number of 88.6. And the increase was driven considerably by less of pessimistic expectations, and also the lower wholesale gas prices, reopening of Chinese economy, all of the boosting the economic confidence. In fact, recently German government has increased its 2023 forecast, and is seeing the unemployment rate remaining at record lows. So the belief is definitely emerging that the Europe's largest economy may avoid recession, as was being thought about just a few months back. Turning to Asia, Japanese core inflation for December rose at the highest rate since 1981 on a year-on-year basis, coming at 4.3% versus forecast of 4.2%, and the previous one being at 3.9%. That helped the yields on JGBs going higher again, but BOJ promptly in the market, buying up more bonds and helping to curb another spiraling moving in the yields. Japanese yen, which is closely tracking the yield curve, holds precariously in the range between 129, 130.50, and that's the biggest suspense. What the BOJ will do on their monetary policy, because even IMF has come out and said that Bank of Japan should let the government bond yields move more flexibly and be ready to raise short-term interest rate swiftly if significant upside risks to inflation materialize. And with an inflation risk becoming more prominent as per the data that we have been seeing. Bank of Japan should give long-term yields freer rein, such as by raising the 10-year bond yield target or widening the range that it tolerates. So, in meantime, Bank of Canada raised their policy rate by 0.25% on Wednesday, but there is an indication that they might go in for a pause, and this may be one of the first of the large central banks to go on a pause. But in contrast, the hotter than expected Australian CPI has given rise to expectation that they would be hiking rates both in February and March. So it's a kind of mixed picture that we are getting globally. US, Europe, and Asia, and China is still an unknown factor. How much of it will be bullish expectations being met after the economy being opened, removing the COVID restrictions. The coming months' data will definitely give some light. In the meantime, investors are not losing much time in investing into Chinese companies once again, as reflected in the rally in Chinese markets, and also the Chinese one, which has made long strides on higher. Overall dollar helped by stronger numbers from US, and as I said, already leading some to believe that Fed will stay its course, and this is supporting dollar with a solid support at 101.50, resistance to euro above 100, rather 109, GBP above 1.2440. While good buying is seen in these currencies on dips, more consolidation and profit taking should be seen in the coming months as well. But of concerning note for me is the move by NATO members to supply war equipment to Ukraine. The US and Germany both said on this week that they would be sending dozens of tanks to Ukraine, a major shift in aid that gives the war-torn nation more firepower against Russia. Meantime, Kremlin has not lost time in reacting, and they see it as a direct and growing involvement of the NATO in this conflict. And in fact, Russian ambassador to Germany called Berlin's move an extremely dangerous decision, and the ambassador to Germany called Berlin's move and very provocative move. So I think market has lost focus on the possibilities of this war situation escalating, particularly taking into account that Russia has been hurt a lot by the recent oil price cap. So keep an eye on these geopolitical developments, even as the monetary policies are looking at a crossroads. On the rupee, of course, we are stuck between 81 and 81.80, thanks to central bank's active involvement in directing the moves, and of course the flows will determine whether we do keep on the improving side towards 81 once again, because after the current IPO related flows, not heard much about any fresh inflows, and with oil price already inching towards 88, that is the Brent, rupee may actually test the resistance above 81.80 in the coming days, and clearing of 81.95 may pave the way for 82.40. But again, these things will have to wait until we get through the two major events lined up next week. That's Indian budget and the FOMC. Thank you, and have a nice weekend.
Okay, folks, that was quite good. And yes, we have been seeing a lot of mixed updates on the jobs market, but all in all, as JK mentioned, there is a strong headline number for US economy, but all the rest of the indicators, many of them are not showing any strong signals, thereby keeping the Fed still on the hawkish side. And if we have to talk about a hawkish Fed, it is good and heavily accompanied by the Australian Central Bank after a very hot inflation number. But a counterpart on the Canadian side, even though the Canadian Central Bank did have some rate hikes this time, but they have signaled the possibility of pausing the rate hike cycle. So it's kind of a mixed bag for many major central banks, even with respect to their stance, as we have been talking about. And if we are talking about central bank stance, BOJ cannot be left out. And BOJ was still seen in the market, in the bond markets rather, managing the yields. And even though many of the economists and institutions have been asking for a reduced intervention or probably increase in the band of yield curve control, BOJ is as of now still acting in the markets. And like JK mentioned, folks, geopolitics haven't really moved out, but the market seems to have been caring a little less about it at current situation. So it needs to be seen how the geopolitics go about. And the next week will turn out to be an interesting one. We have good major events coming up, domestic budget as well as FOMC meeting. So we can expect some bit of an action in the next week. We shall come back and on Monday and provide you all the updates then. Thank you so much for listening and have a good weekend.